Depreciation is the process of spreading out the cost of a tangible asset over its useful life. Businesses use depreciation to account for wear and tear, aging, or obsolescence of assets like buildings, machinery, and vehicles. This helps reduce taxable income by recognizing expenses over time instead of all at once. What is depreciation? When a company buys an asset, it doesn't expense the full cost immediately. Instead, it spreads the cost over several years, reflecting how the asset loses value over time. Example: a company buys a truck for $50,000 and expects it to last 5 years. Instead of reporting a $50,000 expense in year 1, the company might record $10,000 in depreciation each year for 5 years. This helps match expenses with revenue generated by the asset, giving a clearer financial picture. Why is depreciation important? Reduces taxable income. Businesses deduct depreciation as an expense, lowering taxable profit. Spreads costs over time. Prevents financial statements from showing huge one-time losses. Reflects asset value accurately. Shows how much an asset is worth as it ages. Common depreciation methods. Straight-line depreciation, most common. Spreads the cost evenly over the asset's useful life. Example: a $10,000 machine with a 5-year life depreciates $2,000 per year. Declining balance depreciation. Accelerates depreciation in early years. Example: a $10,000 asset might lose $4,000 in year 1, $3,000 in year 2, and so on. Units of production. Depreciation depends on how much the asset is used. Example: a factory machine depreciates based on the number of products it produces. Sum of the year's digits. Depreciates more in earlier years using a specific formula. Depreciation versus amortization. Depreciation applies to tangible assets like buildings and equipment. Amortization applies to intangible assets like patents and trademarks. Both methods allocate costs over time, but they apply to different types of assets. Real-life example of depreciation. A delivery company buys a fleet of 10 vans for $300,000. Instead of recording a $300,000 expense in 1 year, it depreciates the vans over 5 years. Each year, $60,000 is recorded as an expense, lowering taxable income while accurately reflecting the van's decreasing value. Quick recap. What is it? Depreciation spreads the cost of an asset over its useful life. Why is it important? It lowers taxable income, prevents large one-time expenses, and reflects asset value. Common methods: straight line, declining balance, units of production. Depreciation is a crucial accounting concept that helps businesses manage costs, track asset value, and improve financial reporting.